vaccinations and the reopening of the economy, fiscal and monetary policy support, and the healthy financial positions of households and businesses. The rapid spread of the Omicron variant led to some slowing in economic activity early this year, but cases have declined sharply since mid-January, and the slowdown seems to have been mild and brief. Although the invasion of Ukraine and related events represent a downside risk to the outlook for economic activity, FOMC participants continue to foresee solid growth. As shown in our summary of economic projections, the median projection for real GDP growth stands at 2.8% this year, 2.2% next year, and 2% in 2024. The labor market has continued to strengthen and is extremely tight. Over the first 2 months of the year, employment rose by more than 1 million jobs. In February, the unemployment rate hit a post-pandemic low of 3.8%, a bit below the median of committee participants' estimates of its longer-run normal level. The improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand is very strong, and while labor force participation has increased somewhat, labor supply remains subdued. As a result, employers are having difficulties filling job openings, and wages are rising at their fastest pace in many years. FOMC participants expect the labor market to remain strong, with the median projection for the unemployment rate declining to 3.5% by the end of this year and remaining near that level thereafter. Inflation remains well above our longer-run goal of 2%. Aggregate demand is strong, and bottlenecks and supply constraints are limiting how quickly production can respond. These supply disruptions have been larger and longer lasting than anticipated, exacerbated by waves of the virus here and abroad, and price pressures have spread to a broader range of goods and services. Additionally, higher energy prices are driving up overall inflation. The surge in prices of crude oil and other commodities that resulted from Russia's invasion of Ukraine will put additional upward pressure on near-term inflation here at home. We understand that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We know that the best thing we can do to support a strong labor market is to promote along expansion, and that is only possible in an environment of price stability. As we emphasize in our policy statement, with appropriate firming in the stance of monetary policy, we expect inflation to return to 2% while the labor market remains strong. That said, inflation is likely to take longer to return to our price stability goal than previously expected. The median inflation projection of FOMC participants is 4.3% this year, and falls to 2.7% next year and 2.3% in 2024. This trajectory is notably higher than projected in December, and participants continue to see risks as weighted to the upside. The Fed's monetary policy actions have been guided by our mandate to promote maximum employment and stable prices for the American people. Our policy has been adapting to the evolving economic environment, and it will continue to do so. As I noted, the committee raised the target range for the federal funds rate by 1/4 percentage point and anticipates that ongoing increases in the target range will be appropriate. The median projection for the appropriate level of the federal funds rate is 1.9% at the end of this year, a full percentage point higher than projected in December. Over the following 2 years, the median projection is 2.8%, somewhat higher than the median estimate of its longer-run value. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. Reducing the size of our balance sheet will also play an important role in firming the stance of monetary policy. At our meeting that wrapped up today, the committee made good progress on a plan for reducing our securities holdings, and we expect to announce the beginning of balance sheet reduction at a coming meeting. In making decisions about interest rates and the balance sheet, we will be mindful of the broader context in markets and in the economy, and we will use our tools to support financial and macroeconomic stability. As we noted in our policy statement, the implications of Russia's invasion of Ukraine for the U.S. economy are highly uncertain. In addition to the direct effects from higher global oil and commodity prices, the invasion and related events may restrain economic activity abroad and further disrupt supply chains, which would create spillovers to the U.S. economy through trade and other channels. The volatility in the financial markets, particularly if sustained, could also act to tighten credit conditions and affect the real economy. Making appropriate monetary policy in this environment requires a recognition that the economy often evolves in unexpected ways. We will need to be nimble in responding to incoming data and the evolving outlook. And we will strive to avoid adding uncertainty to what is already an extraordinary. We are attentive to pressure on inflation and inflation expectations. The committee is determined to take the measures necessary to restore price stability. The American economy is very strong and well positioned to handle tighter monetary policy. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thank you. Let's go to Gina at the New York Times.
Hi, Chair Powell. Thank you so much for taking our how you're considering the risks of going too fast and potentially tipping the economy into recession, and how you're weighing those risks against the possibility of going too slowly, allowing inflation to become embedded and kind of getting behind the curve.
So I guess I would start by saying that, in my view, the probability of a recession within the next year is not particularly elevated. And why do I say that? Aggregate demand is currently strong, and most forecasters expect it to remain so. If you look at the labor market, also very strong. Conditions are tight, and payroll job growth is continuing at very high levels. Household and business balance sheets are strong. And so all signs are that this is a strong economy, indeed one that will be able to flourish, not to say withstand, but certainly flourish as well in the face of less accommodative monetary policy. So I guess that's how I would say I'm looking at that. Of course, the objective is to achieve price stability while also sustaining a strong labor market, and that is our overall objective. But we do feel the economy is very strong and well positioned to withstand tighter monetary policy.
Thank you. Let's go to Howard at Reuters.
Hi, Chair Powell. I was wondering, in the SEPs, you have quite a markdown to GDP from 4 to 2.8%. I'm wondering, how much of that do you feel is a result of the Fed's stiffer than expected action here? You talk about monetary policy operating with a lag, but is this going to bite quicker than expected?
I don't think that's a big piece of it, actually. I think some of that is just an early assessment of the effects of spillovers from the war in Eastern Europe, which will hit our economy through a number of channels, highly uncertain. But you're looking at higher oil prices, higher commodity prices. It'll be so that we think that will weigh on GP to some extent. So that's part of what moved those assessments down. I think generally monetary policy works with a lag, so some of that would also be in there. But remember as well that 2.8% is still very strong growth. If we think that the potential growth rate of the economy is somewhere around 1.75%, 2.8% is strong economic growth. It would have been one of the strongest years, in fact, of the last expansion. So while it's lower than last year's 5.8%, it's still quite strong growth. So I would say it's quite a strong forecast.
So in that context, what would trigger you to go faster or slower on the rate hikes? Ongoing increases doesn't really tell us whether this is going to come in bigger chunks or evenly paced through the year.
Yeah, so the way we're thinking about this is that every meeting is a live meeting. And we're going to be looking at evolving conditions. And if we do conclude that it would be appropriate to move more quickly to remove accommodation, then we'll do so. I can't be perfectly specific about it, but that's certainly a possibility as we go through the year.
Thank you.
Thank you. Let's go to Rachel at the Washington Post.
Thank you, Michelle, and thank you, Chair Powell, for taking our questions. I'm curious if you can be specific on when you expect to see inflation will start to come down, especially with the combination of rates going up, fiscal aid dissipating from the economy, and supply chains getting better. And if you don't start to see that, how will you signal it? What will you be looking for, and what will you be looking for over the course of the year? Thank you.
So I guess I would say that at the before the invasion of Ukraine by Russia. So let's go back to that. I would have said that the expectation was that inflation would peak sometime in the first quarter, maybe the end of the first quarter of this year, and then maybe stay at that level or a little bit lower, and then start to come down in the back half of the year. So now we're already seeing a little bit of short-term upward pressure in inflation due to higher oil prices. Not natural gas a little bit, but not so much for us since we have our own natural gas supply, other commodities prices. The other thing is that you're seeing supply chain issues around shipping and around, lots of countries and companies and people not wanting to touch Russian goods. So that's going to be more tangled supply chains. So that could actually push out the relief we were expecting on supply chains generally. So I guess I would say that the expectation is still that inflation will begin to come down in the second half of the year. But if you look at where I read the SEP headline median, we still expect inflation to be high this year, lower than last year. And then we expect, though, particularly with the effects of the war, but also the data we've seen so far this year, we expect inflation to remain high through the middle of the year, begin to come down, and then come down more sharply next year.
Let's go to Nick at the Wall Street Journal.
Nick Timmeros of the Wall Street Journal. Chair Powell, over the last 6 months, the Fed has shifted its policy stance quite a bit. 6 months ago, you were still buying assets. Most officials weren't projecting any interest rate increases this year. And yet, despite the shift over the last 6 months, real rates are as negative today as they were then. So how concerned are you that further inflation surprises will offset the effects of recent policy firming by leading real rates to stay at levels that do not actually provide much restraint to the economy? Thanks.
So that's one of many ways of capturing the situation, which is that the committee really does understand that the time for rate increases and for shrinking the balance sheet has come. And I would just say, I would go back to the economy is very strong. As I mentioned, tremendous momentum in the labor market. We expect growth to continue. It's clearly time to raise interest rates and begin the balance sheet shrinkage. And I just wanted to say that as I looked around the table at today's meeting, I saw a committee that's acutely aware of the need to return the economy to price stability and determined to use our tools to do exactly that. You couched it in terms of real rates. I would say if you look at the SEP, you've got people getting close to or even above, in many cases, their estimate of the longer run neutral rate. So I understand that doesn't do it for real rates, but if you go out a year or two, many people are in their forecasts are having tight policy from a real interest rate standpoint. So that's something that we're focused on. Of course, it's a highly uncertain environment, and we don't know what's going to happen, but we do know that we're going to deploy our tools to achieve our goals, and that includes the price stability goal.
Let's go to Victoria at Politico.
Hi, Chair Powell. So looking at the summary of economic projections, you all have inflation coming down over the course of the year to 4.3%.